The US dollar was mixed yesterday, but however, at the end of the US session, it managed to stage a minor rebound despite the fact that the ECB and the Bank of England has signaled a higher chance that next year monetary policy will be much more on hold, and potentially there could be an interest rate hike in Eurozone next year. The US stock market recovered yesterday after the core US CPI data came in below expectation. But however, several economists sounded skepticism about this lower trending US CPI data for November due to the distortion of the information that's being gathered after the US government shutdown. Gold XAU USD traded firm above its 20-day moving average. Very good morning to all. I'm Kelvin here. Welcome back to today's Daily Dose of Market Insights. Today will be the Friday, the 19th of December 2025. So before we start, let's have a quick look at the disclaimer. Leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is for general information purposes and is not investment advice. Past information is not representative of future results. Right. Seems that the screen is not moving. Just do a quick check. Right, I think the screen is good. Okay. All right. So let's have a quick look at what has taken shape yesterday and as well as in today's early Asia session. All right. So let's talk more about the situation unfolding in the monetary policy outcome of Eurozone and the UK. So let's start with the Eurozone first. All right. So the Eurozone came in within expectation, I think, in terms of the monetary policy guidance. But what's surprising over here was that, yes, the Eurozone paused for the fourth time to hold the key deposit rate at 2%. But however, the ECB, very interestingly, has upgraded inflation trend growth and as well as economic growth prospect for 2026, 2027, and 2028. So if you look down the chart over here as being shown in this Bloomberg News Media report, what we could see over here is that inflation, excluding food and energy, for 2026, there was actually a big bump. Earlier forecasted was the September staff projection was at 1.9%, and ECB staff projection now bump it up to 2.2% in the December forecast report that is highlighted in black. Similar for 2027 as well. Previously, it was at 1.8% for the September forecast. Yesterday forecast, it upgraded it to 1.9%. And the freshly out of the oven, they also provided a 2028 forecast as well, a longer term one, to expecting the ECB, we call it Eurozone inflation trend, excluding food and energy, to maintain at the stable rate of 2%. So that was being desired by ECB. Still recall that 2 years ago, ECB is on a path of interest rate cut policy with the risk of deflationary spiral ranging in Eurozone due to that conflict up from Ukraine and Russia that is at that point in time is still showing no signs of ending. So with that Russia-Ukraine peace negotiation treaty that is now being brought to the forefront and with increasing probability of that occurring due to US given a kind of a NATO-like guarantee to Ukraine, that actually jives down in line with ECB latest staff macroeconomic projection to actually increase inflation trend, but not a very steep level, but going back from a growth trajectory after having the risk of a deflationary risk spiral 2 years ago. And also they bump up their GDP forecast as well, or projection for 2026. So previously it was forecasted at 1.9%, it bumped up to 2.2% for 2026. And by the end of 2007, they bump it up to 1.9%. And this 1.9% is expected to maintain, sorry again, yeah, 1.4%, pardon me, just now the cursor was not there. Let me repeat again. So in 2026, the GDP growth forecast was bumped up to 1.2% from 1% previously in the month of September forecast. So in 2027, the latest December forecast was bumped up to 1.4%, and hence in 2028 it will maintain stable at 1.4% for Eurozone GDP growth forecast. So all in all, what GDP forecast over here is a growing situation in ECB, where previously it was being marked in the risk of deflationary, and this deflation has transacted into a growth trajectory. So what it means right now is that ECB monetary policy going forward will be a potential hike in 2026. All right, no more going into a cutting cycle. Net overall, in a longer term perspective, it should support a weaker dollar. All right, then later I'll share with you guys why the dollar did not weaken significantly yesterday, because of two factors: skepticism on the latest core CPI data, and as well as from a technical factor, because the ongoing mean reversion rebound in the US dollar index hasn't ended yet. Okay, potentially. Now back to the Bank of England. So Bank of England yesterday, so this ECB, where is the Bank of England? Bank of England cut rates for the third time this year to bring it to a 3-year low of 3.75%. But however, their big boss, their chief, which is the Bank of England Governor Bailey, say that there is more limited spaces for reduction as the current rate is now reaching a neutrality level, and costs will become closer with the pace of cuts expected to ease off at some point. So this is rather of a less dovish guidance coming out from BOE, Bank of England Governor Bailey's, warning that next year do not expect more intensive pace of interest rate cut coming out from UK, given the fact that there is now limited room for Bank of England to cut rates further, as the current rate at 3.75%, pardon me, has reached a neutrality level. So that also sounded that Bank of England may also start to take a long pause in 2026 after cutting for the third time this year. All right, so net overall, it also supports a weaker dollar. Right now, the situation come over here is that while the release of the inflation data in US surprises everyone with slower than expected rise, so the core, let me share with you, the core CPI rose just to 2.6% year on year instead of 3% that is being forecast over here. But however, some categories, analysts await for December report for clearer data after shutdown. So what you could see over here, okay, skepticism abounded about the remarkably low inflation readings, and even Fed chair himself last week had cautioned that because of federal staffing was affected by the shutdown for much of November, a skeptical eye was noted for November CPI figures. And several economists noted that the 2-month change in key shelter categories, which are some of the biggest components of the CPI, were basically flat, calling the calculation into questions. So there is a air of skepticism regarding about the way the data that is being portrayed in the November core CPI data release, which came down below, way below expectation, which was 2.6% instead of 3%. And several economists, after crunching into that numbers, kind of doubt this 2.6% trend. Is it an actual representation of the current inflationary trend situation in the US? So that also created the feedback loop back into the FX market, preventing the US dollar from falling further yesterday. Despite we have on the onset, we clearly see two events, the Bank of England event and the ECB event, which sounded giving us guidance that the next move will be either a pause by Bank of England and a potentially a hike by ECB, but that didn't fuel into a outright dollar weakness yesterday due to the skepticism of some economists has sounded out on the reality of this 2.6% year-on-year core CPI data growth for November, due to some skepticism of how the data is being calculated. So if you look at the US dollar index, it continues to bounce after I say that it managed to stage that bullish hammer pin bar candlestick on the 16th of December, also hitting our support level at 98.03. So this bounce is more ongoing. So we have 2 days of consecutive rally. Wednesday and as well as Thursday exposed ECB, exposed Bank of England, exposed CPI data release for the US. So what it's trying to do now is trying to do a potential mean reversion back towards the 20-day moving average at around 99 figure level, followed by 99.25, which is the intersection between the 50-day moving average and the 200-day moving average. So this potential ongoing mean reversion rebound may continue, given the fact that in the last 2 weeks we have a kind of jump the gun US dollar weakness. All right, so that has already starts to price in by the event from ECB and Bank of England that has already taken shape. So it's something like a market move ahead of the event, and after the event has taken shape that came in within market expectation, there's a bit of unwinding of earlier shorts position undertaken by short-term speculator in the FX market. Before the event, that was much more sentiment skewed towards a weaker dollar, and the event did support the weaker dollar. So after the event has taken shape, nothing big has surprised us, and potentially there could be some form of unwinding of this earlier short dollar position, as being evident by the US dollar index showing signs of this mean reversion rebound continuing towards the 20-day moving average, which is at now 98.97. Then thereafter will be 99.25 maximum potentially, which is the intersection between the 50-day and the 200-day moving average. All right, so that's for the FX market. Then overall for the stock market, we see a relief rebound led by the heavily beaten down big cap technology stocks that has a higher significant weightage in the Nasdaq 100, leading the fall yesterday, up by 1.51%, whilst the rest of the indices like the Dow Jones and the Russell 2000 trail behind with 0.14% and the Russell 2000 0.62%, the SPX up by 0.8%. So later I'll touch on the technical chart of the 3 major US stock indices that we cover on a frequent basis, with the SPX 500, the Nasdaq 100, as well as the US Wall Street 30 that represent the Dow Jones Industrial Average. And what's interesting, if you look at the heat map of the S&P 500, so those heat maps that were deeply in the red in the start of the week, which is centered on the mega cap technology stocks, with relation to the risk on, risk off situation in the AI space, NVIDIA up by 1.87%, which is among the leading leaders of the mega cap technology stocks, followed by Amazon up 2.5%, Google up 1.9%, and Metal up 2.3%. So that fueled the rebound in the Nasdaq 100 yesterday. Now, going forward in today's Asia session, so I will see in Asia session right now, in terms of the Asia Pacific stock indices, the Nikkei 225 also rallied as well. Still recall that yesterday we do have a bullish bias on Nikkei 225 because the slide that was being seen from Tuesday, Wednesday, and as well as early Thursday Asia session time has come close to a medium-term pivotal support level. And even the Hang Seng Index managed to stage a bounce, 0.4% right now, in line with the positiveness that's being seen on the CSI 300 Index, up 0.5%. And if you go down to the Southeast Asia market, our STI Straits Times Index is trading almost unchanged, and Australia ASX 200 is up by 0.44%. So what we could see over here is a bit of a risk-on situation that is taking shape in the Asia Pacific stock market over here. Now, key events to look out for as we're speaking right now will be definitely the Bank of Japan interest rate decision. So ahead of this Bank of Japan interest rate decision, which is more likely to be an interest rate hike that has been priced into the market. So what's interesting over here is that before BOJ released the monetary policy decision making and as well as the statement, and after that, market participants will be focusing at 2:30 p.m. Singapore time, which is the press conference of BOJ Governor Uda, to look out for hints about BOJ monetary policy stance into 2026. All right. So the Japan finance minister early this morning, around about an hour ago, so that's about Singapore time 10 a.m. She made a comment stating that fiscal policy will support market confidence alongside with BOJ normalization and regional stability. So she flagged Japan Finmin finance minister flags out fiscal sustainability and debt reduction focus over here. So Japan finance minister signals greater focus on fiscal sustainability and the debt to GDP reduction frame as confident booster over here. So what it means that, you know, in the last 2 months ago, where we have the new Japanese administration come in, and this new Japanese administration is in favor of very aggressive fiscal policy. That means we talk about pumping up the economy using fiscal policy, like giving a reduction in tax cuts over here, and as well as using JGB bonds to debt finance their so-called physical expansionary plan to invest in infrastructure and whatsoever. So that actually created a bit of fear in the JGB market, because with a higher, more aggressive momentum of fiscal policy, that could increase the budget deficit of Japan. So once the budget deficit of Japan is being increased, market participants in the JGB bond market will have a fear that Japanese credit rating, so rating may fall further because of the inability for the Japanese government to finance these aggressive fiscal stimulus plans over here that send the JGB yield, especially the long-term yield, the 30-year spike up to an all-time high, and as well as the 10-year JGB yield rally up to a 30-year high as well. Then that has a bit of negative feedback look into the stock market, because of fear that it may raise borrowing costs of Japanese corporation, which could potentially trim their profit margin. Okay, so very clearly there is now a kind of realization by the administration to actually give this kind of remarks to smoothen out the fears of this spike up in the JGB yields that may have a indirect and direct detrimental impact on the Japanese economy and the Japanese stock market. All right, so it means that right now, whatever things that is taking place in Japan right now, the administration has acknowledged it, that the Bank of Japan inevitably will have to rise rates right going forward. Okay, we can't go back to negative rates anymore. All right, there's no way for them to go back, because of the economic situation in Japan doesn't justify that, because inflation has already been trending upwards, the 2% long-term target, for about 2 years. And in fact, the latest CPI data that came out from Japan just a while ago at 7:30 a.m. Singapore time today, let me have a quick look. The core inflation rate that Bank of Japan closely monitored over the core rate, because the core inflation rate exclude both fresh food and energy, rose to 3%. It just came down slightly below 3.1%, but at 3%, it's been holding above the 2% level for the past 1.5 years. If you look at the trend, all right, give us the 5-year trend. So notice that it has been hovering around the 2% level after a slight dip in July 2004. Ever since in August 2024, it has been hovering at the 3%, 2% above the 2% long-term desired target by BOJ. So if you ignore the July 2024 dip down to 1.9%, if you look at it has been holding above the 2% level since almost 3 years ago, since October 2022, where the core inflation trend spiked up to 2.5%. So given the fact that Japanese economy is no longer at a threat of deflationary spiral, there is no fundamental reason and no, we call it a rational reason for Bank of Japan to go back into a quantitative easing cycle again. So that has a realization on the new Japanese administration, who wants a cheap monetary policy coming up from Japan. That means forcing Bank of Japan to cut rates and go back rates down to zero. So that is not possible given the current reality of the current situation Japanese economy is facing. So that actually causes the Japanese finance minister, which is part of the new administration, to come out and address this situation, that eventually interest rate got to go up in Japan. It's only that a gradual increase. Meanwhile, the finance ministry will embark on more fiscal sustainability to actually lessen the debt burden of the Japanese economy. So that also created a positive feedback loop into the Japanese stock market, which managed to stage a bounce at 1.2% or 1.16% as we are speaking right now. Right. So before we go, let's have a quick look whether the Bank of Japan has it released their monetary policy outcome, because usually it's about 11 a.m. Singapore time, correct? So Bank of Japan hiked its short-term rate by 25 basis points to 0.75% as expected over here. So now will be the press conference, all right? Okay, so this is it. Okay, so let's look at the quick summary from Investing Life. So in its statement, Bank of Japan acknowledged that inflation has remained above its 2% target for an extended period, which I explained to you guys earlier on, supported by not only imported cost pressure, but also firmer domestic price dynamic. At the same time, policymakers emphasized that real interest rate remain clearly negative, reinforcing the view that monetary conditions are still accommodative even after the hike over here. So now going forward, let's take a look at the JGB, the dollar yen rate over here very quickly. So the dollar yen didn't actually move, spike up by higher at 156 level. All right, so later I'll touch on the dollar yen technical analysis and the key levels to look out for. Okay, so very quickly now, let us now proceed to the second segment of the daily dose, which is the intraday technical outlook segment. All right, so before that, let me expand my screen over here. Okay, so let us start with the data of, let's start with the FX market over here. All right, since we are talking about the dollar yen, so immediately I just jump straight to the dollar yen right now. Okay, so the dollar yen right now is bounce up, it's spiking up over here. So now it's testing our short-term pivotal resistance level that we highlighted earlier. Oops, pardon me, that we highlighted earlier on Thursday, right? So on Wednesday, we are looking for that bounce. The bounce almost come close to our already hit our first resistance level earlier at slightly below the 155.50 level, 156.0 level. And the second resistance we highlight was 156.10. So then with that, yesterday we emphasized 156.10 as my short-term pivotal resistance for us to look for a potential bearish bias scenario for it to actually drift downwards towards the 50-day moving average. So right now, it exactly spike up, hit this level over here at this point in time. So given the fact that it didn't clearly break through at the 156.10 level, that means i.e. the bearish bias is still pretty much intact as we are speaking right now over here. So what I could have over here is that there are two key levels. There's one key levels to watch out for, or two key levels to look out for over here to have that to increase the bias for it to drift down towards 154.40 again, which is the 50-day moving average, and as well as the minor swing low that got survived on the 16th of December, confluence with the 5th of December minor swing low as well. So with that, let me draw this low here over here. Okay, so this is the low at the US session, which is 155.35. Followed by 155 figure level. Right, so these are the two key support level to look out for as we await for Bank of Japan Governor Uda press conference at 2:30 p.m. Singapore time. Okay, 1535, 155 figure level, which is the minor ascending trend line linking the last two higher low from 16th of December and 17th of December. So once we see a breakdown below 155 figure level, potentially the probability will increase for it to drift down at least in the near term on the intraday basis to retest 154.40 in the first step, which is the rising 50-day moving average. All right. However, if we start to see a breakout and the hourly close above 156.10, then potentially we will see a squeeze up towards the top of the range over here at 156.60, maximum 157 figure, 157.15, which is the congestion area of 20th of November and 25th of November this year. All right, so that's the technical outlook for the dollar yen. Still watching closely the 156.10 figure level. So potentially there could be still a chance of a drift downwards back to retest the 154.40 50-day moving average, but provided that we need to have a breakdown below 155.35 followed by 155 figure next. All right, so that's for the dollar yen. Okay, next up will be the Aussie dollar over here. So the Aussie dollar, what we could see is a bearish reaction right exactly at our test of the 6630 short-term pivotal resistance that we highlighted yesterday. So given that there's a bearish reaction of the 6630 resistance, there could be still some form of bearish biasness for this Aussie dollar to continue this mean reversion decline to retest the 20-day moving average at 65.80 for today. So I'll be using 66.30 for sure short-term pivotal resistance level to look out for this potential drift downwards towards 65.80. Near-term support level to watch, that will be the 20-day moving average. A breakdown below the 20-day moving average maximum, potentially we could expose the next near-term support at 65.40. So this 65.40 is the 50-day moving average, and as well as the minor swing low area of 1st of December and 2nd of December, and so confluence very closely with the 50% FIBO retracement of that previous bullish impulsive up move before the mean reversion decline kickstart, 21st of November low to the high of 11th of December. All right, so that's for the Aussie dollar, still maintaining that bearish bias for the mean reversion decline scenario to potentially continue, using 66.30 as my short-term pivotal resistance to maintain this bias. Only a bullish breakout and an hourly close above 66.30 will invalidate this mean reversion decline bias to see a squeeze up to retest the important 66 figure level, important 66.60 level. A breakout above 66.60 level will increase the chance of a bullish impulsive upmove sequence coming back into the Aussie dollar to test 66.90 in the first step. So that's for the Aussie dollar. All right, so now let me go on to the European currency over here. Okay, before I go there, just to make sure that the screen is good over here. All right, so I think the screen is all right, good. The screen is good. So basically, let us start with the euro dollar. All right. Okay, so the euro dollar yesterday drifted between the first support level at 117.10 and below our pivotal resistance level at 117.70. All right, over here. So also indicating the lack of upside momentum as well. And what we could see is that the hourly RSI continues to drift downwards. All right, over here, and slip back below the 50 level mark. Okay, 50 level mark, indicating the lack of upside momentum. So with that, we will still be using 117.70 given the fact that it hasn't broke out above 117.70, 117.70 short-term pivotal resistance level for the euro dollar. Maintain that bearish bias for the continuation of another residual push down for the mean reversion decline scenario towards the 116.80 level / 116.55, which is the key 20-day moving average, confluencing very closely to it. So potentially this could be a residual push down towards 116.80, 116.55 before another bullish impulsive upmove sequence resume on the euro dollar to search higher high. So for now, potentially given the current technical element that I explained to you guys, with the lackluster bullish momentum that's being seen on the hourly RSI, there could still be a residual push down on the euro dollar using 117.70 short-term pivotal resistance level. A breakdown below 117.10, which is our first support level yesterday, may expose 116.80 / 116.55 next. Only a bullish breakout above 170.70 will invalidate this residual mean reversion decline scenario to invoke a potential bullish impulsive upmove sequence to retest 117.90, 118 figure level, followed by 118.20, and thereafter 118.60 in the days ahead. So that will be a FIBO extension level as well of 2 times over here from the low of 5th of November. So that's for the euro dollar. Next up will be the sterling pound over here. All right, so the sterling pound squeezed up yesterday, retested the swing high area of 16th of December and also close to the previous Friday 12th December swing high area as well. So before inching downwards, all right, over here. So it still can't break above the pullback resistance line of this former minor ascending support level from the low of 21st of November, now turns into a pullback resistance where there's a bearish reaction of it. So for today, I'll be watching the 134.50 level, given that it tested twice and there's a bearish reaction of it yesterday, and the bearish reaction of it also took shape close to the pullback resistance of that former minor ascending channel. So 134.50 short-term pivotal resistance level, maintain that having that bearish bias on the sterling dollar for it to potentially retest last Wednesday minor swing low area at 133.25. A breakdown below it will potentially see a residual push down for the mean reversion decline to hit a inflection level at 132.70, which confluence very closely with the 20-day moving average and the 50-day moving average, and as well as close to the 50% FIBO retracement. If I do the FIBO retracement, right over here, okay, it came close to the 50%, around the 50% FIBO retracement as well. So this 132.70 thereabout could be a potential inflection level for the sterling dollar to kickstart a potential new, fresh, bullish, impulsive upmove sequence. Only a bullish breakout above 134.50 will invalidate this mean reversion decline scenario to resume its bullish impulsive upmove sequence forward towards the next intermediate resistance at 134.90, 135.50 / 135.80 FIBO extension cluster level, and as well as the minor swing high area of 18th of September this year. So that's for the sterling dollar. All right, so that sum up all the 4 major US dollar pair. So now let us now proceed with the stock indices over here. So the stock indices, let us proceed with the Asia Pacific, starting with the Hong Kong 33 that is representing the Hang Seng index. So the Hong Kong 33 broke above our upper neutrality limit at 25,580 yesterday and did a minor pullback during the US session, and before trading up higher, bouncing up from it during the Asia session today. So given this new short-term positive technical development, and also coupled with the hourly RSI shaping a series of higher high as well, then for that, I will have a mild bullish bias scenario for today, for it to actually drift upwards towards the top of this key range resistance level over here, where the 50-day moving average has been capping previous boosts since the retest of it on the 2nd of December. So for the entire month of December, it can't break above the 50-day moving average. So still being trapped inside this kind of sideways range configuration after yesterday price level hit the critical low of 21st of November, critical low, and managed to survive. So I'll be using yesterday's Thursday minus V-shaped recovery scenario here. There's a minor V-shaped recovery you can see over here at 25,300, slightly higher above the critical swing low area of 21st of November, which is at 25,120, where the Hang Seng where the Hong Kong 33 managed to survive on Tuesday. So using a rather higher short-term pivotal support level for today. For now, at the moment, 25,300, that will be my short-term pivotal support level. 2 resistance level to watch as it's showing potential signs of drifting down upwards towards the range. Upper limit 25,790, a breakout above it exposes 26,010, 26,140. Only a bearish breakdown below 25,300 will see a retest on the critical swing low area of 25,120. A breakdown below 25,120 then will invoke a deeper minor corrective decline sequence towards the medium-term pivotal support level, which confluences with the key 200-day moving average at 24,765 / 24,620. All right, so that's for the Hong Kong 33. Up next will be the Japan 225. So Japan 225, yesterday we do have a bullish bias because of the price action starts to break up, starts to shape that bullish signs of a bullish, we call it momentum emerging, which indeed it takes shape and it managed to share a bounce and hit our first resistance level at 49,850 before showing some signs of profit taking right now, which confluences with a bunch of key technical elements as well, which is the 20-day and the 50-day moving average over here in pink. So with that, given that price action has really bounced, so for a better risk management perspective, I will use yesterday's US session low, which also tests the former high of 18th of December. So that's Asia session high before it turns into a pullback support and form a bullish hourly hammer candlestick low right exactly at 49,133. So round down 49,130 over here. So this level here will be my short-term pivotal support level, given how the price react positively yesterday at this level during the US session. Okay, using 49,130 short-term pivotal support level over here. to maintain that bullish bias on the Japan 225 above 49,850, potentially exposes 50,490, maximum 50,985 for today, which is the stubborn minor swing high area that the bulls can't surpass since 4th of December this month. All right. So only a bearish breakdown below 49,130 will negate this bullish bias scenario to see a further slide down to retest the medium-term pivotal support at 48,450. So still maintaining that bullish bias. So for a better risk management perspective, I will tighten the short-term pivotal support level, or have a short-term pivotal support level at this important intraday level that where the price action managed to rebound during the US session, which is at 49,130 on the Japan 225. That is representing the Nikkei 225. Onward next will be the Germany 30, that is representing the German DAX. So the Germany 30 squeeze up, broke above our short-term pivotal resistance level, didn't drift downwards as intended towards 23,670. So evoking a bullish reversal scenario that's taken shape. So given this strong bounce back up above the 50-day moving average, right exactly at the 20-day moving average, it could actually indicate that the bulls are now much more in control, at least in the shorter term for the Germany 30. So given that the RSI has started to exit from the overbought level, we could see over here after yesterday's strong spike up, potentially there could be a chance for a minor pullback. So minor pullback, first support level to watch will be very close to the 50-day moving average, which is this congestion area over here at 24,020. Hence, using the minor swing low area of 18th of December, which managed to shape that minor bullish reversal after a retest of the previous congestions resistance area at 28th of November. All right. And so converse very closely with the rising 20-day moving average as well at 23,860. So using 23,860 as my short-term pivotal resistance, using 23,860 as my short-term pivotal support level, flip to a bullish bias on the Germany 30. So if we start to see a clear breakout and hourly close above 24,235 thereafter, we will tighten our short-term pivotal support level towards 24,020. Then next resistance level to watch will be 24,395, followed by 24,000. Let me move this up. 24,560, 24,620 next over here, which is the congestion area of 6th of October and 9th of October. Only a bearish breakdown below 23,860 will invalidate this bullish bias scenario to see another round of choppy minor corrective decline sequence unfolding, exposing the next near-term support level, which confluences with the key 200-day moving average at 23,670, minor swing low area of 3rd of December and 2nd of December, and so confluence with the 50% Fibo retracement of that previous bullish impulsive up move sequence from 21st of November low, push it up to the high of 12th of December, where the 50% Fibo retracement also confluence at 23,670. That's for the Germany 30. All right. Next up will be the major US stock indices, starting with the US Wall Street 30, that is representing the Dow Jones Industrial Average. So the Dow Jones Industrial Average, we have a wild swing between the neutrality zone, exactly that we highlighted yesterday, at 48,460, 47,790. So it seems to us that the hourly RSI has started to trace out a higher lower, this low higher than this low area higher than this low, indicating some form of upside momentum that may have resumed on the Dow Jones Industrial Average, which is the US Wall Street 30 CFD index in our platform. So hereby using yesterday's lower neutrality zone as my pivotal support level, which is 47,790, since it's now back below the neutrality level and also back at a retest of that minor ascending channel support drawn from the low of 21st of November, we will have a bullish bias for today, but be in a range first. So bullish bias, first resistance level to watch will be the current minor range stop at 48,460. That was almost tested yesterday. A breakout above 48,460 may expose 48,770 next, pardon me, in the intraday basis. Only a bearish breakdown below 47,790 will invalidate this bullish bias within a sideways range scenario to see drifting downwards lower towards 47,510 break below 47,510 may expose further weakness towards the 50, I think towards the 50-day moving average as well. Yeah, at 47,180. Right, close to the 50-day moving average. So that's for the Dow Jones Industrial Average, which is the US Wall Street 30. Next up will be the SPX 500. So the SPX 500 managed to stage a bounce above the tightened neutrality range yesterday. So yesterday we have a tight neutrality zone between this 6,780 and 6,720. So it cleared above the upper limit of that neutrality zone, which is 6,780, did a pullback, and this pullback now is showing signs of rebound again in today's Asia session, right exactly at the 6,780 level. And what's interesting over here is that the hourly RSI has started to see a series of higher low as well. We could see over here, and also starts to bounce off right exactly at the 50 level mark after a retest close to it at the end of yesterday's US session, indicating that the ongoing minor bullish momentum element is still lingering in the SPX 500. So with that positive development based on the latest price action on the SPX 500, we will now flip to a bullish bias from a neutrality stance yesterday. So given that it hasn't cleared above the 6,840, 6,870 near-term resistance zone, where it formed this series of lower high during the start of this week, we will not use a very tight short-term pivotal support level at 6,780 right now. So we'll be using at 6,720 for now first, unless we have a clear bullish breakout above 6,870, then I will tighten it to 6,780. So using 6,720 short-term pivotal support level on the SPX 500, flip to a bullish bias stance. Resistance zone to watch out for in the near term for today, 6,840, 6,870, only a bullish breakout above 6,870. In the first step, we'll see a retest at the current all-time high at 6,930. Only a bearish breakdown below 6,720 will invalidate today's recovery scenario to expose the next two support level at 6,660, followed by 6,610, which will confluence with the 61% Fibo retracement and a 76.4% Fibo retracement of that previous impulsive upmove sequence from the low of 21st of November to the high of 12th of December. So that's for the SPX 500. Lastly will be the Nasdaq 100. That was the weakest major US stock indices since from Monday all the way up to the Wednesday this week. So what I could see over here, it peels up, but it still remains below our short-term pivotal resistance that we have yesterday around the 25,200 level. All right, this level here is slightly below the 50-day moving average and the 20-day moving average as well. So what we could see over here is that the price action didn't hit our desired support level at 24,580 yesterday. It only printed a low of 24,697 due at that point in time. All right, over here, they printed this low before bouncing up. So given the fact that the hourly RSI is also showing signs of bullish momentum, very, very similar to the hourly RSI like the SPX 500, a series of higher low, and price action managed to shape a bounce off the 50 level mark as well, above the 50 level mark. So indicating that short-term momentum still remains on the bullish side right now. So with this short-term bullish momentum that is lingering in the Nasdaq 100, I will not be so convinced of a bearish bias for today, given the latest price action to drive it down towards 24,580, which is the 61.8% Fibo retracement of that previous impulsive upmove sequence from the low of 21st of November to the high of 11th of December. So given this positive technical element, this could be the low already at 24,697 instead of 24,580 being the inflection level to kickstart a brand new bullish impulsive upmove sequence. So for today, I will flip to a neutrality stance first for now. 24,870, lower limit of the neutrality stance, where price action shaped that 3 candlestick consecutive of bounce low. That's the start of it. So there's some form of sentiment where this bullish momentum starts to kickstart exactly at the low of this 3 consecutive bullish candlestick. The low will be at 24,870, followed by 25,380. All right, which is very close to the 20-day moving average. Right? Neutral between these two levels. However, if we see a bullish breakout above 25,380, then I will have more confidence to validate a bullish impulsive upmove sequence that may have injected into the Nasdaq 100 to retest the stubborn resistance, range resistance of 25,760 / 25,830 in the next step, which was being resisted since 5th of December. A breakout above 25,830 for sure will continue its upward drift towards 26,070, followed by a test at the all-time high at 26,290, which is the all-time high on 30th of October. Only a bearish breakdown below 24,870 will reinstate that residual push down to retest 24,580 next. All right, so that's for the Nasdaq 100, and also sum up all the intraday technical outlook on the major stock indices. So let us now touch on the gold market, XAU/USD. So for gold, yesterday it did a squeeze up, almost hit the current all-time high in October at 4,380. So yesterday it printed an intraday high of 4,375 before drifting downwards and hit our first support area again at 4,310 thereabout. So still no change. These are the support levels to watch, where price action, every time it dip, there will be a potential bounce taking shape. So first support level 4,310. Short-term pivotal support level will be the 4,267, 4,243. So still maintain that bullish bias because it hasn't broken below 4,267, 4,243. A clearance back above 4,380 now for sure will give us more higher probability that we are now in the midst of a bullish impulsive upward sequence towards the next intermediate resistance level at 4,430, 4,440, which is the upper limit of this medium-term ascending channel in place since the low of 28th of October this year, as well as a Fibo extension cluster level. Only a bearish breakdown below 4,243 will invalidate this bullish bias scenario to see a further drift downwards. So that means, i.e., another round of minor corrective decline sequence exposing 4,205, 4,155 maximum, which is converging with the 20-day moving average close to the lower limit of this minor ascending channel support, and as well as the rising 50-day moving average, all coming very close to it at 4,155. So that's for gold XAU/USD. Lastly will be the West Texas crude oil over here. So the West Texas crude oil, yesterday we wanted it to bounce up higher towards the 47,021, 54,000, 48. Pardon me. Yesterday we have a bullish bias to see the extension of this mean reversion rebound extending further towards the 57.21, 57.54. All right, a bit of time twisting earlier on, but price action is getting a bit of lackluster movement over here. So what you could see over here is that from a intraday perspective, price action on the 1 hour chart, this particular price action take in the form of a bearish chart pattern, which is a head and shoulder. All right, so this is the left shoulder, this is the head, and this is the right shoulder. All right, a head and shoulder, a bearish head and shoulder formation. So with this intraday movement, which the hourly chart, minor bearish head and shoulder formation, it indicated that this mean reversion rebound may not extend further, and in fact this mean reversion rebound may have already hit an inflection level, which was the high of Thursday at the Asia session, 57 figure level, and may resume its impulsive downward sequence thereafter. So with that appearance of this minor bearish head and shoulder formation, I will be lack of confidence to have that mean reversion rebound extending upwards towards 57.2, 57.54. So instead, I'll be using 57.21 / 57.54 as my short-term pivotal resistance zone to flip back into a bearish bias on the West Texas oil. A breakdown below the neckline of this inverse of this head and shoulder minor bearish formation at 55.75 will trigger off a further weakness scenario potentially to retest this week low at 55.23. A breakdown with it below 55.23 will inch down lower towards 55.50 level next. Only a bullish breakout above 57.54 will invalidate the bearish bias view to see a further extension of the mean reversion rebound to retest the 20-day moving average, converging with the minor swing high of 12th of December, acting as the next intermediate resistance at 58.22. So that's for the West Texas oil. So before we go, let's have a quick look at the economic calendar. What are the key data to look out for other than the 2:30 p.m. Singapore time, the Bank of Japan Governor Uda speech over here. So after 2:30 p.m., it didn't highlight over here in trading economics. So if you look at the investing live, there's a calendar over here. Let me share you guys. Where is the calendar? Okay, can't find this calendar over here. Yeah, this is the calendar. I'm not sure where is the calendar. Give me yeah, this one calendar. Sorry about that. Okay, so you look at the investing live calendar. Okay, so just make sure that the target +8. So the speech over here will be at 2:30 p.m. Singapore time, BOJ press conference. All right, so later that this will be a key event to look out for. 2:30 p.m. Singapore time, Bank of Japan Governor press conference. So market participants will be sharing his view next year. The potential interest rate hike that may continue, that market participants expected, and his viewpoint on the current state of the JGB market over here as well. Then what we could see over here is that the next calendar to look out for will be data, will be at 3 p.m. Singapore time. We have the Germany consumer, 3 p.m. Singapore time, yes, Germany consumer confidence data for January. So they're forward looking. So that will potentially shape the movement intraday on the Germany 30 CFD index, and as well as in some form the euro dollar and the euro crosses. All right, over here, then we have 3 p.m. Singapore time, the retail sales for UK that may impact the sterling dollar and the sterling crosses. Right, then thereafter will be a quiet session over here. So for US, not much of an interest over here. So that sum up the daily dose of market insight for today, and also today's will be the last daily dose for 2025, as I'll be away for the next 2 weeks, and also in the next 2 weeks I also do reckon liquidity in the global markets will also starts to temper off. So with that, I wish you guys a great day ahead, a great holiday season. Merry Christmas in advance and Happy New Year. Wish you guys great health and prosperity into 2026. And we shall speak again on the 2nd of January 2026, where Daily Dose will resume. Thank you.